Good morning, everyone, and thank you for joining today's webinar presented by Altfest Personal Wealth Management. My name is Jesse Frailing. I am the Director of Retirement Plan Services here at Altfest, and I will be your moderator for today's webinar. First and foremost, on behalf of our entire team, we wish continued health and safety for you and your families. As physicians, you are on the front lines of this pandemic. We salute you and your service, and we are so grateful for everything you are doing to make the world a safer place. We are at an unprecedented place in our history with everything that is happening in the world right now, and unfortunately, there are a tremendous amount of people, many of whom work in healthcare, who are experiencing loss and sadness. As a firm, our job and our passion is to help our clients manage their finances. But in the current environment where there is so much going on outside of that realm, we wanted to acknowledge that, and we will continue to do our part as a firm and as people to help each other get through this difficult time. We also recognize that everyone is experiencing this time with a unique set of needs and circumstances. Here at Altfest, we all continue to work very hard to help each of our clients navigate through these times of uncertainty and at the same time uncover opportunities that every crisis carries with it. If you're not familiar with Altfest Personal Wealth Management, we were founded as a fee-only financial planning firm in 1983 and currently manage about $1.3 billion in assets on behalf of our clients. As a fiduciary, it is our mission to always put the best interests of our clients first. We offer truly comprehensive financial planning and investment management and specialize in providing services tailored to physicians throughout their careers and into retirement. Whether you are working in private practice, with a hospital group, or whatever the case may be, Altfest has extensive experience working with physicians in different situations. We would like to recognize two organizations which we are proud to partner with. The Medical Society of the State of New York, for which Altfest serves as the preferred wealth manager for its over 30,000 members, and the New York chapter of the American College of Surgeons, for which Altfest serves as the preferred wealth management education provider for its over 3,000 members. We would also like to recognize everyone who is not affiliated with either of these organizations, and we thank you once again for your attendance today. Now I'd like to introduce today's speakers. Stephen Novack and Ben Lake are both senior financial advisors at Altfest Personal Wealth Management. Today's topics of conversation will be tax options to take advantage of in a lower income year, refinancing your personal or commercial mortgage, and identifying investment opportunities in a volatile market. If you have any questions during the webinar, please feel free to type them in the chat box on the left-hand side of your screen. We will do our best to answer all of them live, but if we don't get to your question, we will follow up with you over email after the webinar. And also, before we begin, I wanted to make sure everyone knows that we do have a very brief survey that will pop up on your screen after the webinar has ended. It takes less than a minute to complete, and it would be very helpful to us if you could complete this survey once again after the webinar has ended. With that, I will turn the presentation over to Stephen Novack to get us started. Stephen?
Thank you, Jesse. Again, want to thank all of you for your service, the time that you have spent with your patients, going to the hospitals, individual practices. I am a son of a dentist, so I have experience with the individual practices and how those work. But right now, what we're going to talk about are tax opportunities. I'm going to talk a little bit more as if you're self-employed, but I'll also adjust for the hospitalists out there and talk to you and tell you how the differences might be. But in general, the conversation is pretty much the same. Obviously, the main difference is the self-employment tax and some additional how your retirement plans might work because of that. In general, what are we talking about this year? We're in strange financial times. If you're self-employed, your general income might be decreasing because you're seeing less insurance patients. If you're working for a hospital, you can be taking a pay cut, maybe either in your current wages on a weekly basis or expectation of some type of bonus at year end to drop. So what are we talking about? What are we trying to do? Because your tax bracket might drop, we really are looking to take advantage of that. Which is usually the opposite of what you would do in a normal year. You know, as your income goes up, you're looking to see how you can lower your taxes for the year. Well, if you have liquidity this year, you might want to do a little bit of the opposite. If you are in a lower bracket because of the change in your income, you might want to recognize some income to fill that bracket up and take advantage of the lower tax rate. How does that work? If you're in your own practice, you might have some form of collectible, account receivables that you can collect, go out to patients or go out to certain forms of billing and try and bring that money in to increase the revenue for the current year. Appreciated assets, that could be stocks, that could be a house, that could be if you're collecting a car or something else that has a gain, to try and pick that up and pay the capital gains on that at a lower rate for the year. Roth conversions. We talked about this in a prior conversation. I'll touch on this briefly. If you do have any further questions, please contact us and we can go over your situation, because this is very much a person-by-person situation. We would need to have an estimate of your income, and as the year progresses, and those numbers firm up, we could figure out the best way to do this. But a Roth conversion would allow you to take money out of an IRA and pay the tax on it currently. So if you're at a lower tax bracket, it would make sense, and put that into a Roth account, which then would grow tax-free even when you take the distribution later in life. These accounts typically are held till the last piece to have the money removed. There could be some situations where you'd want to take that earlier, but in general, these are good vehicles to gift money to children or family members after you pass, because they will then also get an additional 10 years of tax-free gains on that money. So the money would continue to grow and they can take it out with no tax to them. Reducing expenses. Now, this is a little bit more of what you could give to yourself or not. So when I say expenses, the first thing I have here is retirement plans. If you're contributing to a 401k, some type of individual retirement plan, if you have your own practice, a 403b, if you're at a public hospital, if you are going into a lower tax bracket by giving this money, it might not make sense to put that money in this year. It might make sense to put additional money in next year at a higher tax bracket. So if you're at the 32% tax bracket and you fall into the 28, the benefit of that tax savings just lost 8%, and that's on a federal level. New York State and New Jersey, those levels will decrease there. So it could be, let's say, 10 to 12%, depending on the tax brackets you're in. Next, we're talking about itemized deductions. If you're going to a lower tax bracket, charitable giving might not be as beneficial. So if you typically give in December, and this year is going to be a lower income year or sometime towards the end of the year, it might make sense to wait for that contribution until January, when you think, assuming things get back to normal and you'll be at a regular tax bracket next year. So if you're on a full Schedule A, where you itemize your deductions, something like that might be interesting. Business expenses. If you do have your own practice, hospitalists would not have this current situation because you're not itemizing your own deductions. But if you're buying equipment for your business and you have not to run the business, but a major purchase that you're thinking about doing, again, it might make sense to wait to January to do that. The advantage of that is you'll get a bigger deduction on your taxes for doing it. Next slide, please. This is an example that I was working with a doctor who is self-employed, has his own practice. The scenario here would be not too different if you were a hospitalist. Instead of having the business income, which you see highlighted, that number would be included in your W-2 income. But in this scenario, we had someone's wife working, and earning about $50,000 a year. Interest, dividends, you know, small amounts, about $10,000 in total that you see here. Short-term capital gains, long-term capital gains, all those numbers I'm keeping steady. The only difference I'm doing here is I'm adjusting the business income. So in the original scenario, the business was earning net $350,000. In the second scenario, we reduced that by about a third, so $100,000 down to $250,000 for the year. The self-employment tax, if you are a hospitalist, you would not be paying that on your own. So you would not be getting, you wouldn't be paying it, and you wouldn't be getting that deduction there. That would be being paid by the hospital, and half of that would be coming out, or well, that amount would be coming out of your W-2, excuse me. And then we can look down, this person did not itemize the deduction, so it's just a standard deduction for the year. The total tax in this individual scenario is $110,000 in the normal case. Now, if you were a hospitalist, that would be reduced by about the $24,000 on your tax return, because you would not see the self-employment tax or the deduction of the income from that, the $12,900 that's highlighted above. In the second scenario, again, you see $79,000. So this doctor had a reduction of $30,000, of which part is self-employment tax, part is regular tax. The interesting piece of the example that I was giving when I was talking through the ideas is the ordinary income tax brackets below. The income tax brackets, as you can see, went from 32% here to 24%. That's an 8% savings just on any the next dollar you earn. In this scenario, he had about $55,000 of income still that he can recognize within the 24% tax bracket. Now, depending on where bracket you fall in, the capital gains rate on the bottom, in this scenario, there was no change. But the bracket could be, if you're in the 20%, you could fall down to 15, or if, you know, depending on how your practice is going, when income falls low enough, or you can defer income, you can go down to the 0% tax bracket. And in those situations, it does make sense to start looking into any appreciated assets that you do have that you can recognize. Next slide, please. Now I'm going to talk about mortgage refinancing. This is probably touches home a little, or closer to home for more people, depending on the last time that you refinance your home and what you have done. What are we talking about? What is the major consideration? The most important fact is, how long do you plan on staying in your home? If you plan on moving in 3 to 5 years, this probably is not much of a benefit and something we should be talking too much about. But if you have 17 years left, or if you just have a 30-year mortgage and you're pretty close to the beginning of that, we can talk. The types of mortgage we're talking about here are conventionals. Most conventional mortgages, we're talking about what you hear on TV, the Fannie Mae, the Freddie Mac, Ginnie Mae, Veteran Associations, USDA, those are the ones you hear on the news the most. Those have limits depending on the region. Being in the New York, New Jersey area, your limit is the highest in the country. I think depending, well, that'll depend on the bank you go to, what they'll recognize and what they won't, but what is still considered a conforming mortgage is at the upper limits. Non-conventional mortgages, you were talking about the jumbos. The other one is a limited doc. If you're a self-employed doctor or self-employed dentist, as just my father was, he had a limited doc mortgage. What that means is, because you're not receiving a W-2, that sometimes they will charge you a little bit higher interest rate because they can't confirm your income as easily. They can look at your tax returns, but that's no guarantee year after year. If you're a hospitalist, you really don't run into this situation, so that is a lot easier and something you probably won't have to deal with. Rates. What we're talking about here, you can have a fixed rate, which over the entire life of the mortgage would be the same, and ARM, sorry, yeah, thank you. An ARM, which is an adjustable rate mortgage, or an interest only. Interest only were much bigger back in around 2008. They still exist, they're still out there. I have clients who have them, but they're not as big. Those usually don't pay anything but interest, nothing towards the principal for 5 years, 10 years, and then they get refinanced after that, because usually it's like a balloon payment where you owe the full amount after that. A lot of those clients then would either get another interest only, maybe reduce some of the principal, but that depends on your current financial situation. Next slide, please. So now let's talk about why we're doing this. Number one, rates. I just actually worked with a client yesterday who went from a 5 5/8 down to a 3% mortgage. They had a 30-year mortgage. She had 16 years left, and she's going down to a 15-year mortgage. So she's losing 1 year of payments and saving almost a little over 2.5% of interest rates. But what do you consider? What's the upfront cost? What's going to go into these mortgages? Closing costs are points. A point is a percentage. Like if you pay 1 point on a mortgage and a mortgage is $500,000, that means upfront you're going to pay 1% as basically like a interest buyout for the lower rate. Appraisals, they're going to send someone out. They're going to appraise the property. They're going to look at it, make sure that the mortgage is covering something that's worth the value. Title insurance, they'll do a title search, make sure that in case there's any liens or anything else that they missed, so you're gonna have to pay for the insurance. State and local recording fees. New York State has a higher recording fee. Virginia has a higher recording fee than New Jersey does if you refinance. So those are things that the hurdles that you have to overcome. Now, what can you do with those? You can pay those costs up front, or you can do what's also called a capitalization, which actually would add it to your principal balance and increase that principal balance. It will increase your payments over the term of the mortgage, but depending on how much that is, it's usually not too much adjustment for the monthly payments. It could be $25 to $50, depending on how much those closing costs are. Now, what I was describing is the remaining term before. Are we looking at a 15-year mortgage, a 20-year mortgage, a 30-year mortgage? If you have had a house for a while and you've paid down considerably, closer to a 15 or a 20-year, you might want to look at the shorter terms. The other option is if you plan on staying there, or you are fine with extending the principal payments, or the total payments, I should say. If you're 25 years into a mortgage, instead of going down and paying a higher balance lower, you can extend it back out to 30, which will save you more a month, but then you'd be making payments for an additional 5 years. One other thing I do want to mention, I want to show you an example first, and then I want to go into one other topic briefly. Next slide, please, Jesse. Here's just a quick example of someone I was working with down in Virginia. They had a current balance of $670,000. They had this mortgage at 4 1/8, which is 4.125 at a rate. They bought the house 2 years ago. And so they had 28 years left on the mortgage, and the current payment was $3,366. Down in Virginia, as I said, they had closing costs for refinancing. There's a reporting tax within Virginia itself, so the closing costs were about $6,000. The new rate was 3 1/4. So he decided to put the $6,000 into the balance, capitalize the cost. So the new balance was going to go up by $6,000 to $676,000, and he was going to extend his payments 2 years. Now, if you look at the bottom, his payment goes down. It's in the $2,950 range. So he's saving about $425 a month on this mortgage. Now, he will have 2 extra years of payments at the lower rate. But if you look at the 425 and divide that into the 6,000, at about 15 months, he'll break even on that. And then he still has to make up those 2 additional years of payments, but he'll more than do that over the life of this mortgage. So this basically added to his cash flow over $400 a month that he has liquid cash to do what he wants. Him and his wife are expecting a baby, and that's part of the reason why they did this. They wanted to have the cash to spend on the child. One other topic that I did want to talk about is the CARES Act. If anyone is having problems with paying their mortgage, and real problems, not necessarily that they are a little bit concerned, but are actually have liquidity issues, the CARES Act does provide certain aspects that you can ask for forbearance to your bank. The rules typically are for agency mortgages. They're pretty standardized for the agency mortgages. If you have conforming, if you have a non-conforming mortgage, you have to call your servicer and find out the rules that they're following, because the government rules that are printed in the CARES Act don't cover those. But you can ask for 180-day forbearance, which means that you do not have to pay your mortgage for 180 days. It does not reduce what you owe. You will owe that money. It's just basically giving you a temporary stay. And you can request on the second 180 days. It is not guaranteed, but you can make that, that request. All these have to be arranged with the current servicer. Hopefully that number should be on your mortgage statement if you have any issues and need to do that. Interest will still accrue on the amounts you're not paying. And how you pay this money back, you should ask the servicer. The forbearance amount can be, excuse me, can be required to be paid after the 180 days. They could add it on to the end of your mortgage, or they could adjust your monthly payment for the rest of your mortgage to account for the change that you have done. So those are all additional facts that you should think about. If you have any questions about any of this information that I provided, feel free to reach out to Altfest. We can set up a call. We can start discussing some of these things. We're definitely here to help you through this situation. And again, thank you for your service and your time. And I'm going to pass this on to Ben, and he's going to talk about investments.
Thank you, Steve. And thank you all again for joining our webinar today. As both Steve and Jesse mentioned, we're all honored and delighted to be able to work with many great physicians, dentists, and numerous other people who are out there kind of helping the entire community face the many challenges that are going on these days. And building off of what they described, the way we work with our clients is very comprehensive in nature, and it's all designed to help them achieve their longer-term financial goals. And I think that's particularly important to keep in mind in times like this, times when there's a lot of risks out there. There might be stresses, particularly financially, social, work-wise, anything that's going on. And so being able to kind of refocus on what's it all for, how are we striving to achieve those longer-term objectives, I think is critical to making sure that you're following the right processes that can be put in place. And so putting that in the context of investments, creating customized investment plans for all of our clients and implementing them in a way that's kind of custom tailored to their goals, their risk tolerance, their values, and their tax situation is really one of the key ingredients in the way we create financial plans for all of our clients. So that's become, again, a major focus in this most recent time period, because obviously we've been experiencing much higher volatility than usual, certainly a very sharp drawdown followed by this sustained recovery. And one thing that I think is the main takeaway from my presentation today that I'm just going to state up front is that even though we are going to continue to face risks, potential volatility in the coming months and quarters, and certainly many challenges both within and outside the investment world, when we look back on this period, this year, 5, 7, 8, 10 years from now, no matter when you kind of decided to make sure that your investments were in the right place, it will be viewed in history as a good time to be incrementally adding to your investments, buying things that are potentially cheaper, attractively priced. Now, with that said, in the short term, we want to acknowledge that there are several risks facing investors today. And so overall, our portfolios at Altfest have maintained a defensive posture at its core, but we're looking for attractive opportunities to incrementally add exposure to some of the types of investments that might perform well or above average going forward. So with that said, I think one important thing to note is that obviously we had this extremely sharp sell-off that was 30 to 35% in only a matter of weeks. It was historic in nature, but we've seen a sustained rebound since late March. And a lot of the reason for that was the very quick and very extreme measures, both in scale and scope, taken by the federal government and governments across the world. So certainly that really helped put a stop on people's fear about the economy, people some more confidence, helped people who were suddenly furloughed or unemployed or facing reduced income. But what you're seeing on this slide is that the magnitude of that may present challenges in the future. So the fiscal stimulus put out by the Treasury Department is likely to increase the annual budget for this current year from what was only 4.5% or so in 2019 to upwards of 13.5%, potentially higher if we do an additional round of stimulus. going forward. And that's likely to continue to be kind of an elevated deficit, as you can see from this chart, going forward. So the problem there is that may, over time, eventually add to fiscal debt. It may cause budgetary constraints, and the possible risks for an investor that may lead to rising inflation over time, and certainly from the Treasury Department point of view, as rates rise, it may become more difficult to service that debt, and they may need to raise revenues or cut spending. And as our founder and chairman recently flagged, Lou Altfest mentioned that there may actually need to be higher taxes going forward. So as Steve was saying, now is a particularly important time to at least be having the conversation about how to plan for the future, potentially take advantage of the current opportunities available. At the same time, the Federal Reserve also had a historically large level of monetary stimulus, which was really focused on creating liquidity in the financial markets that were most susceptible to potential liquidity issues. Things like the bond market, muni bond market as well, interbank lending facilities. And what you're seeing here is the impact of those trillions of dollars in added monetary stimulus. So this chart is what's called the yield curve. What it's essentially showing is on the horizontal axis, this is the maturities of different kinds of treasury bills and bonds, starting at the short end at 3 month, 1 year, 2 year, and 3 year very short term bonds, going out further to longer term dated bonds, 5, 7, 10, and even 30-year treasury bonds. And then on a vertical axis, you're seeing the yields that those bonds are generating. And the two lines here are different time periods. So the gray dashed line is kind of an average shape of the yield curve in the middle of this most recent bull market back in 2013, which shows that even though rates at the very, very short part of the curve were very low, as you got to 10 and 30-year treasuries, you were at least earning 3% or almost 4%. But now, this most recent monetary policy has really compressed the entire yield curve so much that at the end of April, if you were holding a 10-year treasury bond or bought one new at that point, you were only going to be earning 0.64% over 10 years on an annual basis. And even at 30 years, you're only earning 1.25%. And so if inflation eventually picks up to even its longer term average of around 2 to 2.5%, which is also the Fed's target, that means that people who are holding these bonds are going to actually lose purchasing power. They're going to lose wealth over time because inflation will be rising faster than these bonds are earning money. And that's a real challenge for any fixed income investor going forward. And so what a lot of people have been essentially incentivized to do by this program is what the Fed wants, what the government wants, which is that they want people to save a little bit less, invest a little bit more. They want people to spend. They want corporations to spend and invest on growth. But certainly for those of us who are sitting for retirement, maybe already in retirement, or looking to generate a safer income portion of their portfolio, a lot of what's happened is people are forced to take on additional risk in that part of their portfolio, maybe reach for yield in places like high yield bonds or leveraged loans. But the problem there is that in those kinds of credit areas, quote unquote credit areas, what could happen, what often happens in times like this when unemployment suddenly spikes, is that often is a leading indicator of a wave of rising bankruptcies and a wave of defaults. And so investors in those lower quality, higher risk loans and bonds may wind up losing significant portions of their investments there due to those defaults. So it's very, very important to be much more selective and follow a very disciplined kind of risk-focused approach, especially in the fixed income space in this environment. Now, that all being said, we are more constructive on our outlook for equities over the long term. And I'll come back to our short-term outlook momentarily, but over the long term, I think it's heartening to kind of look back at history and see how overall equity markets have performed in different kinds of good, bad, and medium economic environments. And so what you're seeing on this chart is that going back, over 70 years of data, when the unemployment rate is high, well above average, above 6%, versus when it's at a more kind of normal rate of between 4.3 and 6, and compared to even very good times when unemployment's very low, below 4.3%, you'll see that on the right, the S&P 500, which is the large cap US stock index that's kind of the bellwether for the US stock market, its annualized average gain is well above average when the unemployment rate is higher. Essentially because the stock market tends to be decent, not perfect, but decent at being a leading indicator of predicting rebounds that might happen over time. And you see that the opposite is true when times are very, very good, that it's often the case that the stock market is disappointed when people are already expecting the very good economy or very good economic situations to continue going forward. And the same is true if you look at this exact same concept from the perspective of real GDP growth. So this next slide is showing that, again, when real GDP growth is already very low versus when it's very high, you'll see that on the right side, the S&P 500 tends to do much better, again, when things are already at kind of a low point versus when they're much, much higher, when they're already, kind of churning very strong growth out, because again, these things tend to normalize over time. And so it's easy for markets to be encouraged by future rebounds and discouraged by potential slowdowns off of a very high peak. And perhaps just as importantly, or even more importantly, the same trend is being shown with expected earnings growth of these corporations. So what you're seeing on the left is when expected EPS is earnings per share growth of S&P 500 companies is very high, it's very difficult for those companies to kind of achieve those expectations. And so the S&P 500 winds up with rather lackluster results on average. But when people are expecting very low EPS, very low earnings growth as they are now, the stock market tends to outperform, tends to surprise to the upside on the long-term averages. And so because of those three factors, I think that's one real reason why we tend to tell people that, again, even though there might be continued volatility, the bottom may be behind us, but it may not be. We may see another test of those lows in the coming quarters. That over the long term, taking this approach may wind up having much better results than just hiding in cash or being overly conservative or acting more emotionally and less based on the disciplined approach that is often most successful. And so with all that kind of long-term picture said, I think, again, one important concept here is that focusing on the long term tends to be best for achieving those financial goals. And what this next chart is showing is that the range of possible outcomes that the stock market, bond market, and a blended portfolio have had in any 1 year time period can be all over the place. It can be a very wide range. You see in the green bar there, that's the stock market since 1950. Its average, any 1 year period can have very, very high highs or very low lows, and anywhere in between. The bond market, which is a little bit less volatile, which is shown in blue there, a very large, range of outcomes there, but not quite as large. And even with a diversified portfolio, which is 50% stocks and 50% bonds, again, many things can happen in 1 year. But as you move to the right on this chart, you see that over 5-year periods, 10-year periods, and especially over 20-year periods, you see that the averages, the ranges of these kinds of portfolios tend to be more consistent and have a much higher probability of being significantly positive. And certainly, as you're seeing on the right there has not yet been a period that lasted 20 years where stock market, bond market, or diversified portfolio have had an overall negative experience. So again, if those kinds of time frames apply to you, I think it's important to be focused on that approach and take a more kind of disciplined, thoughtful view on how you're constructing your portfolio now to achieve those longer term results. So with all of that said, I'm going to now focus a little bit more on what we're seeing in the current environment. Certainly the US market has been very choppy and certainly recovered very significantly. The same is true to an even greater extent in international markets. And so what you're seeing on this chart is a longer term period here going back to 1997 to illustrate how the US market, which is in gray, and the international market, which is in purple, how those have performed throughout different kinds of economic cycles. So early on, you saw kind of the tech boom and bust, followed by really the great moderation and obviously the great financial crisis of 2008. And then we've had this very extended over a decade-long bull market. But throughout this time period, you tend to see that the S&P 500, US stocks, and the international markets, they tend to take turns leading and lagging each other, but often wind up eventually in roughly the same place. However, that is certainly not the case at the moment. You see this much broader differentiation between how US stocks have performed and how international markets have performed. And as a result, we are seeing that the S&P 500, the US stock market, is actually not particularly cheap right now. It's kind of either at or even slightly above its longer term valuations. And so if you look in the box that's set inside this chart, you'll see that in gray, the current valuation of the S&P 500 is at 19.3 times earnings. It's slightly above its long-term average, and its dividend yield is roughly equal to its average. But if you look and compare at the purple lines, which is the international markets, you'll see that overall, international markets are actually well below the valuations of both its own 20-year history and significantly below the current valuations of the US market, almost 70% of the US market's valuation. And at the same time, at a time when yields from bonds are extremely depressed, you'll also notice that international yields are quite a bit higher than both, again, the US markets. They're almost 1.5, 1.6 times higher than the US market's yield, and they're slightly above its 20-year average. So this is a time to basically be looking at, how well diversified globally is any given portfolio, and what are the right regions to be focusing on, because certainly there's been a very substantial amount of bifurcation in terms of different countries and different regions dealing with COVID-related economic issues, dealing with the recovery and the shutdown since then, and certainly also within certain sectors. And that's true both within the US and outside. And so to give you a couple examples there of where we might be seeing potential attractive opportunities going forward, I think some of the sectors that we're focused on include things like healthcare, technology, to some extent consumer-related sectors, particularly in emerging Asia, as well as importantly energy. And now energy is a bit of a more unique case because they had kind of an additional source of volatility when not only did demand for oil or any kind of energy really get hit very substantially when we went through these lockdowns, but then Saudi Arabia and Russia also had kind of a political, kind of tactical game that they were playing to suppress prices even further. And so that longer term recovery may mean it's extremely important to be focused on potential risks in the short term. There may be more companies that go bankrupt as a result. Smaller companies with less well-capitalized balance sheets may really suffer or even have to be taken out of business or acquired, whereas larger companies may actually benefit from potential consolidation. And so those are the kinds of things where it's incredibly important to, again, be focused on investing with a lens both towards the opportunities at hand, but also the risks that are at play. And so with that, I want to kind of basically conclude my remarks by saying that, again, overall, we do think that this most recent recovery we've been through is somewhat justified. And certainly we do also see that there are lots of risks and challenges going forward. There may be continued volatility. So it's important to kind of be very disciplined, be very selective and careful about what you're investing in. Again, we're maintaining a relatively defensive position, but looking for those opportunities where we can potentially take advantage of longer term growth potential. And so with that, I think I'll pause there because I know I just went over a lot, and I'll pass it back over to Jesse for questions. And thank you all again for listening to us today.
Thank you, Ben, and thank you, Steve. That was some great content that you both spoke about. And we actually do have a number of questions that have come in, so I will start to read them off one at a time here. Steve, this question looks like it's going to be I think, best suited for you to answer. The question is, if my hospital has stopped matching 403B contributions and I want to make up that difference in savings, what are some other areas and some other ways that I can save for retirement?
Okay, so some of the hospitals we've heard, due to liquidity and also employers, are reducing the amount of the match that they're contributing during the year. Options that exist are always depending on your current situation. So we want to discuss income and your total income in the household, joint returns. If your hospital is depending on how much you're earning, you might phase out of some of these because some of them have limits of approximately about $205,000. For options, you can always contribute to a traditional IRA to get the deductible contribution, you can contribute to a Roth IRA if you meet the guidelines. But if those two phase out, then another option would be to do a non-deductible. This is still putting money away, and that money it earns will be tax-free over the life, but you're not getting the current tax savings on the initial amount that you're putting in. There are additional reporting rules. You have to file, I forgot what the form number is, but there's additional filing for your tax return yearly, and you have to track that on a yearly basis going forward until that money is removed. If you don't have a IRA of any form and you do decide to use non-deductible IRA, there are ways to then transfer that money into a Roth IRA, even if you're over the limit. If you do have a traditional IRA, it's on a pro rata basis, so it's not necessarily as beneficial, but that's something you can give us a call and we could evaluate to see the, the additional tax that you'd have to do that, and if it's worthwhile in your situation.
Great point, Steve. Each situation is going to have its unique circumstances, person by person, as you pointed out. So once again, please feel free to reach out to us if you have any questions about your particular circumstances. We'd be happy to speak with you about that. Next question I have looks like it's going to be for Ben. It's regarding our investment approach. Can you talk, Ben, about Altfest's approach to active investment management versus passive?
Sure. Yeah, it's a good question. And just so everyone's aware, what we mean by active management is really when we're using something like a mutual fund, or we have some manager at the helm of a particular strategy who is actively making decisions about which particular securities to be investing in. So an example might be a large cap stock fund where someone's picking the right large cap stocks, as opposed to a passive strategy, which is just basically following an index. Again, not making a decision about one company's better than the other. They're just getting broad exposure to a full index. And these can both be applied to equity, fixed income, alternative type asset classes. And certainly there's lots of theories out there about both. We take the approach that both have a place in portfolios and they both can be used to successful degrees. So from an active management perspective, I think that overall we tend to have a value orientation in our investment philosophy. We believe that investments that are very underpriced tend to outperform over time. And a lot of the active managers that we're using across client portfolios share that belief and embody it in different ways, and have proven that they're able to drive returns above and beyond any kind of fees or costs associated with those managers over the long term and over multiple types of economic cycles. But at the same time, we do also use passive strategies, and we particularly use them in ways that where we're trying to maybe get a more tactical exposure to a specific opportunity or a specific asset class. We also use them as forms of hedging out certain kinds of risk. So an example of that might be, using a shorter term ETF that happens to have built-in protection against downside moves in equity markets, which we actually had been using earlier this year, fortunately prior to the start of this most recent really significant bout of volatility. And so I think that the short answer to your question really is we believe there's a way to use both in harmony to create a more well-rounded, diversified, and stable portfolio.
That's a great answer, Ben, and I'm glad that you brought up utilizing those hedged ETF products, which certainly benefited our clients tremendously during the downturn. I think it's very important to talk about that. Turning to our next question, it looks like it's going back to Steve. Steve, should we be considering Roth conversions this year? And I know you touched upon that topic a bit earlier, and I think it'd be maybe a good time here. Now we got the question about it to expand upon it a bit.
Okay. It's a little bit of like a broken record. Like I said in the first response, it depends. This is something, what's the purpose of doing the Roth IRA? The Roth IRA is to pay the taxes up front today at what is hopefully a lower tax bracket than you'll be in the future. Now, Ben had mentioned Lou Altfest's opinion that depending on how much money that the government is increasing the debt by, taxes in the future most likely will go up. So that makes it more intriguing to do the Roth conversion. The Roth conversion itself, either contributing directly to a Roth IRA right now if you're eligible, or converting IRA money to it. If you're doing a direct input, there's no tax consequences now. You're just not getting the tax savings because you could have done a traditional IRA. If you are pulling money out of the IRA to do the conversion, you're literally taking whatever that dollar amount is and adding that to as a distribution. It's a qualified distribution, so there's no penalty for doing it, but you will pay tax on that money at today's brackets. If because your investments are at a lower bracket right now, or your income is at a lower bracket right now, you're trying to take advantage of that under the assumption that later in life you have enough assets in retirement that your IRA, 403b, 401k withdrawals will keep you at that high tax bracket later on. One consideration where we like to look at people is the years between retirement and when you start taking the Social Security and your required minimum distributions from these retirement plans. Typically, you have a couple years there, depending how late you work. If you stop early in 60, you might have 5 to 10 years to do that. If you're like my father, who worked as a dentist until he was 80, you'd never have that time. So it depends on something, what your plans are. I have a few doctors that are still working. And I mean, I said my father is 80 who are in their 85 and they've never taken their first RMD from their retirement plans from the hospital because they're still contributing to them. That's also a huge advantage if you delay that. So these are all considerations. We'd like to talk to you what your plans are, your long-term plans are, and figure out what would be best in your situation.
Great answer, Steve. Thank you. Once again, very case-by-case basis with the Roth conversion. Ben, I think this is best suited for you, this next question. It goes back to your slide on the differences that have resulted in the yield curve. The question is, where should we be looking for yield in the current environment?
Yeah, it's a great question and certainly a very challenging one, as I described. It's not that simple, obviously, at the moment. I think that when we are focusing on people's fixed income portions of their portfolio, those asset allocations decisions need to be really made again with a view on the long term, but also a recognition of the short and medium term risks that some of the parts of the fixed income market may see significant losses. And so, some of the areas that we've identified as potentially being more attractive in this environment include things like asset-backed mortgages, particularly those, mortgage-backed securities and asset-backed securities, particularly the mortgage-backed securities that are called non-agency. And some portions of those, that particular sector, was really significantly oversold in the downturn, particularly because a lot of those positions were kind of darlings of the hedge fund industry. And a lot of hedge funds that had experienced losses really needed to unwind leverage, and that was one of the ways they had to do that by selling those securities. And so they had been quite undervalued, but at the same time, they do actually have very attractive quality and risk metrics. For example, a lot of the older non-agency mortgage-backed securities tend to have very low loan-to-value ratios. So the people who have those mortgages have lots of equity in their homes. And if that's the case, and they do experience, sudden drop in income or unemployment and they can't pay their mortgage, it may actually wind up being easier for them to sell their home as opposed to defaulting on the mortgage altogether. And because of some of the CARES Act and stimulus package provisions, that area may not have as much default risk as other areas like high yield corporate bonds, leveraged loans, and the like. So that's one particular area of focus for us. Another that I'll briefly mention is that certain parts of the emerging market, the sovereign debt sector, have become a little more attractive, and particularly the part that is denominated in US dollars as opposed to local currencies. We're not really interested in taking on currency risk in this current environment. But a lot of those countries, particularly, again, like I mentioned earlier, in emerging Asia, for example, took very swift measures to protect their societies and their people against the COVID-19 outbreak. And as a result have had the ability to open their economies back up a little earlier than others. And certainly there's still risk with that. But overall, I think their finances are in decent positions and so as a result, they may have much higher yields than things like the U.S. Treasury market does, and even higher yields than other parts of corporate bond markets, but more stable characteristics. Again, it's very important to be careful and selective in choosing that kind of the securities in that sector, because very recently we also saw a day where both Hertz, the rental car company, and the country of Argentina both defaulted. So that was kind of a tough day and a good example of some of the real risks that do remain out there.
Absolutely. So certainly on the bond side of the portfolio, we're taking actually quite a similar approach as on the equity side, trying to identify deep value, trying to identify asset classes and sub-asset classes within the equity and fixed income markets that have been oversold indiscriminately along with everything else, and always keeping an eye on risk, especially on the fixed income side when looking at yields that are extremely depressed from a historic perspective. So thank you for that answer, Ben. I'm going to go back to you actually, Ben, with another investment question. You talked about some of the different sectors that Altfest finds very attractive right now. You mentioned healthcare, you mentioned technology, you mentioned energy, and some others. What about small companies that have perhaps not participated in the recent rebound as much as the larger cap companies? Can you elaborate on the firm's view of small cap in the current environment?
Yep, definitely. I think that it's a good question because it's an important part of the market that during the drawdown really suffered quite a bit more than the average index that people were seeing in their financial media headlines. Some parts of this small cap universe were down over 40% even, and certainly within certain sectors of small cap, energy was down a lot. Financials had a very tough time as well, and some of those particular parts of the market have not recovered anywhere near as much as the averages. So with that said, there's still quite a lot of differentiation that's been happening within the small cap space. So at the moment, we do find small cap value, broadly speaking, attractive. There are risks of what's in there because small cap value may include a bit more financials and energy, and we have very different opinions about financials versus energy at the moment. Energy may be a little more attractive depending on the kind of company we're looking at. Financials that have exposure to what we do believe could be a rising wave of defaults coming, they may have more risk and less opportunity going forward, at least in the current year. But that being said, the overall valuation that we see in the small cap value space is extremely depressed, much lower than its longer term average, maybe 70% or even less of its longer term average. But at the same time, on the growth side of things, kind of the other end of the spectrum, small cap growth names have been one of the most highly valued and potentially overvalued parts of the entire stock market. And so we're kind of taking a much more cautious approach to anything in that particular sphere. So overall, again, this is kind of going back to what I keep saying, but we're focusing on what makes the most sense from a valuation perspective, what also obviously falls within our risk guidelines, and what winds up looking more like an attractive opportunity without creating unnecessary volatility in this current time period.
Great, Ben, thank you. And that's very well said. So even within the small cap space, we are identifying small cap value as a much more attractive opportunity in the current environment due to what you mentioned, valuations, especially as compared to even small cap growth. So thank you for another great answer. I believe we have reached the end of the questions that have been posed. So I think with that, I just want to thank everyone again for attending today's webinar. And thank you again, especially for doing all that you continue to do to keep us safe in a very difficult and uncertain environment. We so greatly appreciate everything that you are doing. And as you can see, once again, if you have any questions that come to mind after the webinar, you can see my contact information on the screen. Once again, my name is Jesse Frayling. I'm the Director of Retirement Plan Services here at Altfest Personal Wealth Management. You can see my direct line here at 212-796-8732. You can also see my email address, which is jfrayling@altfest.com. And if you'd like to learn more about our firm, we definitely encourage you to also visit our website at altfest.com/physicians. I'd like to remind everyone just before we end the webinar once again that there is a very brief survey that will pop up on your screen after we've ended the webinar. It'll take just a minute to complete, not even. So we greatly appreciate you completing that for us, and thank you again for listening with us today. Thank you. Bye-bye.
Thank you very much.